Let's get to our first conversation then. Ed Yardeni, President at Yardeni Research, is with us. Mr. Yardeni, always a pleasure to have you in. I'll start with this whole business of the U.S. government shutdown. Well, we've been at this point before, right? And it usually just passes over after a little bit of noise. You think it'll be more of the same, or could it be different this time?
I don't know. I don't think it's going to be different. We get this drama on a regular basis, and it passes. Sometimes the government does shut down for a couple of weeks, and sometimes that's avoided. My hunch is it'll be avoided. I don't think the Democrats want to be blamed for shutting down the government. They've got enough problems going on, so I suspect they'll fold.
On the data piece, Mr. Yardeni, what have you made of the latest prints? I mean, we saw the inflation numbers last week, end of last week, and pretty much in line with estimates, though now headline inflation is edging closer towards the 3% mark. The labor market data has been patchy. Jobless claims weren't that bad last week. Of course, we'll look out for the non-farm payrolls report on Friday. What do you make of the macros at this point?
Well, the macro data that's come out since the Federal Reserve met to vote to cut the federal funds rate by 25 basis points, all that data has shown that the economy is actually doing very well. Real GDP for the second quarter was revised up significantly from 3.3% to 3.8%. That was on Thursday of last week. And then on Friday of last week, the Atlanta Fed's tracking model is showing that real GDP is increasing at an annual rate of 3.9% in the fourth quarter. Initial claims came out on Thursday suggesting that layoffs remain extremely low. So, we've got GDP being revised up and the payroll employment numbers being revised down. That implies that productivity is absolutely stunning. And if that's the case, there really was no reason for the Fed to lower interest rates. The labor market's just got a lot of strange things going on with the supply, especially. Also, AI is having an impact. I don't think that the last rate cut was necessary, and I don't think there'll be another rate cut this year.
And, you mentioned AI. Good morning. Lots of questions around maybe some weeks that's a large number of questions. AI is entering some bubble zone or not, and some serious people are starting to talk about it. Seriously. But what did you make of that NVIDIA OpenAI deal, Ed? One paying the other to be able to sort of buy their GPUs, and does it remind you of instances in the past?
Yeah, there's a Prince song, party like it's 1999, and maybe it's going to be party like it's 2025, 2026. It certainly reminds one of the meltdown scenario we had with the tech bubble and then the tech wreck, 1999, and a couple of years there into the 2000s. Look, artificial intelligence, AI, I should say, is artificial and it's not intelligent, but it's going to be very useful for certain applications, but it's not going to be the kind of game changer that people are talking about, in my humble opinion. And I think there is a certain amount of hype there. And it wouldn't be a bad thing if the AI stocks just kind of consolidate for a while everybody figures out whether they should be at these elevated evaluation levels. And meanwhile, they're not going to prosper unless they have technologies that really help other companies. The S&P 493, let's say, if we're comparing it to the Magnificent Seven, the S&P 493, I call them the impressive 493, and I think they need to show that they are using AI to increase their productivity. I think that's going to happen, but I think there's a little bit too much hype about this, and the kinds of monies that are being thrown around. I think the market is right to question whether there'll ever be any significant profits on the kind of investments that are being made.
Absolutely, and I think it's a big question of our times, right? And people on both sides, and we'll talk more about this, Ed. Great speaking with you. A short conversation today. Appreciate you joining us here on CNBC-TV18. It's always a pleasure.